armies of bots who try to buy the stocks which have got highest target prices relative to the current price. A number of people who want to have some sort of asset outside of the financial system. And I think that's on an upwards trend. I think it's going to stay where they can stop the market for a couple of minutes. They found an alternative to silver. Silver coins are a very liquid asset in a crisis situation. If we go into a central bank digital currency environment, we see that you're speculating against the...
Clive Thompson, precious metals analyst, retired Swiss banker, and of course, host behind the famous Clive Thompson YouTube channel. It's a true pleasure to host you on Palisades Gold Radio today.
Hello, Stijn, and thank you very much for having me.
It's a great day to be talking to you, Clive. Gold's up 3% pre-market, silver up 7.5%. Very excited to dive into some of the granular details behind that. But before that, I would love to get started talking big picture for a second. When we look at the bull run that we have seen in precious metals, how are the fundamentals looking today, Clive, the 20th of January 2026?
It's not a new fundamentals. We've had the situation for about 4 or 5 years where the mined supply of silver, if we talk about silver here, has been less than the industrial demand for silver. So industrial demand is consumption by the electronics industry, by the solar panel industry, by the automotive industry, and so on. Of course, there's a little bit of that going into investment demand. Now, that gap between consumption and mine supply has been rising, mainly because the mine supply is, it's not rising, it's fallen a little bit. I think it went up last year very slightly, but mine supply doesn't change very much from one year to the next for 2 reasons. First of all, most of the silver is a byproduct of other metals. And secondly, it takes perhaps 5 or 10 years to bring a silver mine on stream. So the mine production has been very, very static. Well, in fact, over the last decade, falling, whilst every year the demand for silver for industrial use, particularly electronics, has been rising and rising fairly constantly. So we reached the point a few years ago where there was a crossover. Demand exceeded supply, and the gap was met by what was, in fact, a huge quantity of above-ground silver. You know, there's an awful lot of silver out there which has been waiting for donkey's years, for decades and decades, to get to its price. And as the price started to rise a little bit, a lot of it came on stream to fill the gap. But of course, as the price went higher, more and more sellers appeared, selling into that increased demand, and those who weren't selling were gradually becoming more and more reluctant to sell. In other words, they were what they call the diamond hands, the ones who don't want to sell. So the first sellers are the paper hands, the weak holders. Gosh, it's gone up $5, I'm out of here. Whereas by the time it's up $20, the people who are sort of shrugging their shoulders and say, well, I wasn't selling it with $5, I'm not selling it with $20, and they're getting stickier. So we're now in a situation where we can clearly see that it's getting harder for consumers of silver, the industrial consumers, to be sure that the silver will be there when they need it. I mean, don't forget, they're running production lines where silver is probably a very, very tiny component of their cost. But if they don't have it, the entire production line for vehicles or solar panels or electronics comes to a halt. So they're really price insensitive when it comes to silver because it's such a small component of cost. So as we go into this situation of a rapidly rising silver price, and a lot of silver is starting to be taken off the market by now hoarders and investors, there's more buyers than sellers. So if you're an industrial consumer of silver, you need to be starting to worry whether you'll be able to get the silver when you need it. Will your production line come to a halt? So it's not a question of how much you pay for it, it's a question of whether you can get it. So I think we're part of the accelerated rise we're seeing now is every silver consumer saying, you know what, maybe there's a shortage, maybe there isn't, but I want to be sure, and they're rushing to market to get what they can just to be first in the queue.
Do you think we'll also see a different market form where more players will step into the mining market directly, take offtake agreements, for example, where they, have certainty of supply by buying silver now for the current price for a few years ahead?
I think it's quite likely that they're looking at those options. You can imagine that certain consumers will be talking to companies like Fresnillo, who mine in Mexico, to see if they can enter into some sort of agreement with them to take off their silver or a percentage of what they mine. This is in a certain sense, this is a kind of royalty agreement where you would give the mining company money so that they can mine more silver. In exchange for the agreement, they'll give you a percentage of whatever they mine. And that would be a way of, I'm going to say inverted commas, assuring the supply of silver. But it's not an absolute guarantee because you don't know what supply disruptions there might be out of the company or country from which you are getting that metal. So I think, if I'm a silver consumer in terms of manufacturing, I'd be looking at multiple sources and trying to strike deals with different companies in different locations.
Yeah, that point is well understood. Looking from as you outlined earlier, perspective of a silver consumer, it's of course a relatively small input cost in your product, for example, solar panels. At some point, the silver price will start to add up. Do you have any gauge for when that point might be that people will start looking for replacing that silver for a different commodity, even if the performance is worse, just because the price is too high?
Well, we have heard already that one solar panel company in China and I forget which metal it was, but they found an alternative to silver, and it seems to be viable at around the current price. So yes, I do think that there will be companies looking for alternatives, but I'm not enough of an expert to say at what price that will happen or to what extent it will happen. I mean, first of all, do bear in mind, it's not so easy to turn around your production from using one thing to another. Even in the motor car industry, changing from platinum to palladium or palladium to platinum is a very complex process. You have to completely rechange your machines and everything else. So it's not something which is done very lightly. But yes, at a certain point it can happen. And the old adage, what we all know is when the price is high, demand will go down, but we've got at the same time a rising price bringing in more and more investor demand. And of course, we've got geopolitical situations. I mean, with the whole debt situation, the global politics, the uncertainty about our money, I can only see that the number of people who want to have some sort of asset outside of the financial system, asset that they control, I don't think that's going to go down. I think that's on an upwards trend. I think it's going to stay. That could overwhelm any declining demand from industrial users as they find alternatives.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. And how much do you think that is already driving the current price action that we're seeing in silver, investment demand, this debasement trade, getting out of fiat and going for hard assets?
It's certainly a factor. I've been speaking with a couple of gold bullion outlets, one in the UK, one here in Switzerland, and the message from all of them, and there was one other, I can't remember where it was, all of them is that the demand at the moment is the highest they've ever seen. They're busier than they've ever been. So clearly there's a lot of physical buying going on. And I can also say that as I talk to people, and I talk to a lot of people, I'm getting the impression that the number of people who are thinking of buying silver is going up. I mean, I was just speaking with a lady 2 hours before you on Zoom, about giving her a consultation on her wealth. she's got exposure to the precious metals, but in paper form, and she's now thinking that she wants to move some of that into physical form. And of course, we had a long discussion about how to store it and where to buy it, and what type of coins she should buy. Should it be small, large? Should it be coins of the realm, and so forth? But people are starting to open discussions which they never had before on silver, in particular. I think perhaps gold has become a little bit too pricey for many people, but for the man in the street, silver is definitely within reach still.
And Clive, correct me if I'm wrong. I believe the last few weeks we have seen an incredible bifurcation in silver price. The West, predominantly paper markets, the East, more physical based. Are we seeing a continuation of this trend, a bifurcation in price?
Well, I think today when I looked, I haven't got it in front of me now, but when I looked earlier today, I think it was about $10 difference, which was close to the highest it's ever been. Now, the difference between the Shanghai price and the COMEX price, we're talking about the near-dated future price, is typically of the order of 50 cents to maybe $1.50 at the outside. And a few months ago, it started to widen. The gaps got wider and wider. A few weeks ago, it was up to $5 or $6. We're all in amazement that this was widening up. And the reason which I saw at the time was that physical silver was not being shipped to China to close the gap, because it's perfectly obvious to me that if you are a large bullion bank and you've got some physical silver available, why would you leave it in New York when you could just ship it to Shanghai and it be there the next day, and you can collect an extra $5 on it, and then you can buy more in New York and keep doing it until the gap is closed. And that wasn't happening, and now the gap has widened, I think, to nearly $10, although it does fluctuate quite a bit. And that it does imply that even though ostensibly there's plenty of silver around, those who would be in the business of shipping it around to arbitrage it can't get it.
Mm-hmm. And is that telling us something about the trust that people have in the Western systems, for example, the commodity exchange in New York?
Well, we're seeing much bigger deliveries of silver out of COMEX. These are people whose futures contracts have reached maturity, who would normally have, or normally futures contracts get rolled over, but we're seeing all-time record deliveries. So last year in January, the deliveries were double the year before, but this year they're 3 times what they were last year, which was already double. So we're now 6 times 2 years ago. So deliveries there's a lot more people asking for delivery, and that was literally every month last year. The deliveries were significantly up, and sometimes an awful lot up from the previous years in many multiples. And it was accelerating a bit towards the year end, and it looks like that continues this year. So we don't know who it is who's demanding delivery. We don't know why they are demanding delivery. That sort of information just isn't out there. But somewhere people are, instead of doing the usual thing of rolling over their contracts and keeping a forward position, they're saying, my contract has arrived, I'll have that. It kind of reminds me a little bit of the 1980s when the Hunt brothers were taking delivery of their silver. They bought a lot of futures contracts, and they upset the market a great deal by starting to take delivery, because the market expected the futures traders to continue to roll over. And here was one player asking for delivery. So they brought in a whole bunch of new rules. I think the main one was called Silver Rule number 7. But basically the rules said you can no longer take delivery of silver if you are using borrowed money to do so, which they were, and if you want to roll your contract for the next series, you're limited to, I don't know whether it's 100 or 1,000 or 5,000 contracts, but a certain number of contracts. You can't roll more than this, which basically left them with zero possibility other than to accept the cash settlement on the maturing contracts. They couldn't take delivery because they'd have to pay for it, and that would mean borrowed money, and they couldn't roll it forward into the futures months because you weren't allowed to have more than a certain number of contracts. And we also saw quite some years ago, and I can't remember when it was, Berkshire Hathaway had the same problem with silver when they'd bought a huge amount of silver and then they got a little sort of tap from the I'm supposing here because we don't have the concrete evidence. They got the tap from the CFTC or the COMEX, but basically they put out a statement at the time saying we understand that a number of people from whom we've bought these futures might not be able to deliver it to us, so we're going to give them time. So it was kind of a sop to the regulator to say we're not going to screw the market. And they obviously got the silver eventually, and then they, some years later, we don't know when because they didn't publish that, but they sold it. So what have we got now at the moment? Someone somewhere taking delivery. Is it one person? Is it multiple parties? I suspect it's multiple parties. I suspect a lot of those parties are industrial users.
Those rules, of course, that you outlined that were installed for the Hunt brothers still apply. Now, if we have multiple players, taking delivery now, of course, that contract limit isn't of so much concern. Do you think there's different tricks they can pull up their sleeves to keep the market orderly?
Well, they've brought in an awful lot of rules over the last few decades. I haven't followed all of them, but they've brought in rules like circuit breakers, where they can stop the market for a couple of minutes when there's a price rise which is too big to restore order to the market. And of course, the most recent rule change they brought in was a week or two ago, I think it was, to adjust the margin requirements to a percentage of the price of silver as opposed to a fixed dollar amount. I think previously the fixed dollar amount, well, it had gone from $20,000 to $25,000 per contract. And now I think they've adjusted it. I can't remember what the percentage was. A percentage of 95, well, whatever the contract's worth. So maybe it's 10% or something like that. I can't remember. But they've adjusted it to a percentage basis, which basically means that if the price starts to rise, you absolutely have to put up more margin if you're a short. Or if it falls, you absolutely got to put up more margin if you're a long. As opposed to the old system where that amount of cash you had to put up wasn't changing just because of a price change. So they're making little tweaks here and there. But of course, in a completely disorderly market, one cannot exclude that there would be a force majeure clause invoked, particularly if it's required to protect the shorts. Don't forget the shorts will be the big boys, the big bullion banks. And we've seen this happen over history many times where there's been a problem that would cause either the exchange or the biggest players to go bust, and exchanges have brought in rules which are designed to protect the short side of the industry, which is the big boys. What happened in the nickel market a few years ago, I think it was 2022, is a good example of that in the UK, where they suddenly, out of the blue, decided to cancel all the contracts from the buyers. They basically said the buyers had bought nickel, it had gone up so much that the shorts were getting, one in particular, short was getting terribly squeezed, couldn't pay the bill, and there was going to be a default. So rather than see a default, they said to the buyers, sorry, your contracts are cancelled. Of course, that's the subject of a legal case now. But, the rules can be changed on you, and you suddenly find you might get a cash settlement price instead of getting the metal you think you'd bought. And then you get the cash, and now you have to go and buy the metal. You find you can't buy it for the amount of cash you got.
Incredibly interesting, all these insights that you have of how this market specifically works, Clive. I'm trying to get a gauge for how much longer this situation in silver that we're seeing could continue. We've, of course, seen an explosive move over the last year and even this month now in early January 2026. How much further could this go for silver, and how much longer could the situation continue to play out?
Well, there's really no limit. I mean, the silver market relative to bonds or equities is absolutely tiny. So all it takes is minuscule changes in asset allocation by the big players, those who hold these trillions and trillions of dollars of bonds and those who hold the trillions and trillions of equities, to say, you know what, maybe we should have 0.5% in silver. or 1/4% in silver. You know, if collectively they were all to decide that at the same time, you know, literally you'd just see an explosion way beyond what we've seen. Now that's not going to happen because these decisions take place very slowly, and for most big players, there's all sorts of implications if you suddenly change what you're doing, because you're talking about an asset allocation change. Don't forget, every large institution who moves money around will have legal departments who have to have their say. They'll have compliance departments who have to have their say. They'll have a safe custody department who decides who our custodians are going to be, where they are, and what form. They'll have a department which decides in what form we're going to take our asset. Will it be in paper form? Will it be in physical bars? Will it be which country? How are we going to do that? You're going to have a chief investment officer. You're going to have an investment committee. You're going to have boards of directors. There's a lot of things to be considered and discussed and argued before a firm can make a change in its asset allocation, especially if it's a new allocation of something they haven't touched before. So going from 0 to 1/4% silver might sound a nice, easy decision, but it's actually a very long-winded process and could take a long time. So it's not like everybody's going to decide on day one. They might all want to on day one, but they can't.
All right. For a retail investor watching that might not have any allocation to silver right now, is it already too late to get in?
First of all, I think that it's sensible for everybody who worries about the way the world's going to work out with the financial system to have something outside the financial system. Silver coins are a very liquid asset in a crisis situation, because if we go into a monetary crisis where people don't want your currency, or the banks are closed, or there's an electricity problem, or whatever it happens to be, and you can't deal, people will very quickly figure out what the value of a 1 ounce coin is. It won't take, it doesn't take you 5 minutes to figure out what it's worth when there's a need. Now, today, if I go and ask somebody in the street, what's my 1 ounce coin worth? I'll bet you that 9 people out of 10 won't even have a clue. But I bet you in a crisis, 9 out of those 10 will know exactly what it's worth and what it could buy. So I think it makes sense to have some exposure in a physical form. And the premium you pay, because if you buy silver, you've always paid a premium, always. And you probably have to pay tax in many countries too, VAT or sales tax. The premium's always been well above the price of silver. But that doesn't mean to say you've got to think about it that I'm buying it because I want to sell it. If you want to buy something to sell, then you go in paper format and you pray that there's nothing happens to the paper market between the time you buy and the time you sell. But if your objective is to protect yourself, have a parachute, have a plan B, have a way out of a complex situation which you don't know what's going to happen, then you need something outside the financial system. Of course, that could be your home, it could be razor blades, it could be bottles of whiskey, it could be anything. But the fact is, silver coins, 1 ounce coins or 1 ounce bars, they're a very negotiable asset, much more negotiable than, let's say, bottles of whiskey or razor blades, which also have a value, enduring value. So it makes sense to have some. So the question is, what should somebody who hasn't got any do? Should they rush out and put all the money they wanted to put in that direction into silver coins now, or what? So the question is it too late? Well, the answer is no. It's never too late. What people should do is buy a little now, maybe buy a few coins and see how they feel. Then, as they grow used to what they've done, and the price might be higher or price might be low, it doesn't matter. Go back and buy some more and gradually increase the allocation, making sure that after each purchase they still feel comfortable with what they've done. But do not spend money on silver coins if the plan is to sell them back next week, because you won't make money unless the silver price goes up another 20 or 30% in the week, because you're going to pay that sort of premium at least to buy any silver. It depends where you are, of course. You might get it cheaper if there's no tax. But what I'm saying is get some, but go slowly. It's like the insurance on your house. You pay the money and you get nothing for it, but you have the peace of mind that if something goes wrong, if your house burns down, you'll be okay. And that's what you're buying. You're buying peace of mind as opposed to the idea to make a profit. As I said, if you want to make a profit, just go and buy something which is in paper form, but you're not buying any insurance with that. You're just buying you're just trading.
Truly great points there, Clive. I would love to ask your take on gold as well for a second. Of course, an incredible return last year, 2025, up close to 70%. Now already close to 10% year to date as a return. Incredible bull market that we're in. What is driving that? Is it also a crunch on physical?
Well, there's another group of investors out there who are wealthier and more sophisticated than the man in the street. And by that I mean the pension funds, I mean the investment portfolios run by large banks, the wealth managers and so forth. I'm seeing more and more wealth managers tell me that they took a bet on gold last year. And I know that's not 100% true. I think it's a fact that over the course of the year, some of them did start to put gold in the portfolios, and I suspect they regret that it wasn't enough. So what we're seeing from a public buying point of view, it's the wealthier classes who are saying, I'll buy gold because it's more of a traditional asset. It's less of a speculative asset. It's not an industrial asset like silver is. And that's finding its way into portfolios for geopolitical reasons. Mathematically, it can now be proven that if you had gold in a portfolio for the last 4 or 5 or 6 years, doesn't really matter, it would have given you a better long-term return, and it would have given you less volatility. That volatility is where the price of the whole portfolio is fluctuating. That's translated it from an investment manager's point of view into something called the Sharpe ratio. That's kind of how they express it. But the real point is, you want to have better returns and you want to have less fluctuations in your portfolio. So any amount of gold in a portfolio would have done that. Now, having done the maths now, they can see that they should have had gold, which they didn't have gold. So what are they going to do going forwards? They're going to start, and some have started already last year, putting it into the portfolios, and we could well go back over time to the traditional amount which certainly Swiss banks used to have decades ago in their portfolios of 5% gold for every client. I think that's entirely possible. At the moment, we don't know exactly how much gold is in portfolios generally, but hearsay is it's less than 1% if you take all the portfolios and all the gold. I think that number is just going to go up. At the same time, we have heavy central bank buying. I think that what's most likely going on is central banks are allowing their government bonds, the treasuries that they own, and it doesn't matter whether they're European or US, they're allowing those bonds to mature as they reach maturity over the next 5, 10, 15 years. And instead of reinvesting it back into the same bonds, or maybe they're investing part of it back into the same type of bonds, I think they're letting part of it slip into gold. We're seeing that from a number of non-aligned countries, quite a few of them, who are adding gold to their portfolio in preference to adding treasuries. Now, I'm not saying that any countries planning to kick America in the teeth by saying, screw you, we're selling all your treasuries. That's not going to happen. That would be, that would be, well, you can imagine the perception if they were to do that. So I don't think that anyone's going to do that, but I think it's just a question of less will go into treasuries and more will go into gold going forwards, and that's actually what's happening. And obviously there's a certain fear that we've seen the weaponization of the dollar against some countries, and countries now starting to say, well, we've been best friends with the USA. What happens if tomorrow we thought we were great friends and suddenly they're turning out to be a threat? Where is Greenland? So, Greenland thought they were great friends with the United States, and suddenly they're not. Well, they still are, but my point is this, that a lot of European countries are suddenly finding that there's all kinds of threats being made if they support Greenland. So how are countries going to start thinking when it comes to how much of their wealth, their sovereign wealth, should be in paper dollars, which can be printed ad infinitum. And if we go back to this suggestion that maybe every Greenlander should be paid $50,000 or $100,000, I mean, in paper money, well, if that were the case, you're being paid in paper money, which could be confiscated at the flick of a button. I'm not sure that's a very good offer. Now, they might look at it differently if they were being paid 1,000 ounces of gold per inhabitant, because then they could bury the gold somewhere in the ice and hope that nobody knows where it is.
Interesting points there, definitely on the mechanics of geopolitics. And an interesting point that you made there, I think, is that a lot of other fiat currencies are also at all-time highs, if at least the gold price in those fiat currencies are. Debt around the world is, of course, a problem around the world. And a lot of these governments need to print more of their fiat currencies to sustain their debt burdens.
There's two types of printing here. One, you've got the central banks who could increase the physical money supply or the money supply in the banks, and of course the banks themselves would create money through the fractional reserve banking system. But the biggest driver of all this is the generalized increase in government debt everywhere. And government debt has been increasing by 6 to 7% globally. Now, what that means is every year the government gets poorer because it borrows money. Someone gets that money, and when that someone gets the money, they try and decide what to do with it. So they might buy real estate, they might open a factory, they might buy equities, they might buy businesses, or they might buy gold and silver. Now, everybody who's getting that money, it doesn't really matter who they are, but collectively they're making decisions to put that money that they're getting from the government, obviously it's not coming to them directly, it's coming through the system, but they're the wealth creators. Collectively they're making that decision to allocate the money they're receiving into a variety of things, and if one of those things is in relatively short supply, and although the above ground supply of gold is immense, most of it's very, very tightly locked up and not going to move, and it hasn't moved for centuries. So when they try to put it into something which is relatively small supply, and the supply of gold is actually only about 1% of new gold a year, it starts to squeeze the price upwards more than it squeezes up the price of something else which is in greater supply. So taking money and putting it into treasury bills or treasury bonds won't push up the price of treasury bonds because the market is too immense and too vast. But if you take the same amount of money and put it into the smaller equity market or the much, much smaller silver or gold market, it's going to move the price further.
Clive, history, of course, doesn't repeat itself, but it often rhymes. Is there a specific time period, historical parallel that you think the time that we find ourselves in right now overlaps with a lot, and we might be able to draw some forward-looking conclusions from?
Well, when I was a child, we were still being issued from time to time with ration coupons in the UK, which actually I don't recollect them ever having to be used, but before I remember, they were being used. So, especially after the war, people had what's called ration coupons. So if you wanted to buy a pound of meat, you had to have a ration coupon for the meat. If you want to buy a pound of butter, you had to have a ration coupon for the butter. So it didn't actually matter how much money you had in your wallet. What mattered was whether you had enough to pay for the meat and the butter and the ration coupon to go with it. So you can imagine, in a certain sense, the ration coupons were worth more than the money. And I can imagine, although I've no personal knowledge of it, that there were buyers out there willing to buy up the ration coupons because they wanted more meat or butter or bread or whatever it was than the legal entitlement. And there were presumably sellers who were willing to take the money. But the real money, at a certain point, was the ration coupon. Now, if we go into a central bank digital currency environment, which I think is the direction of travel in many, many countries, even if they say they're not going to do it, they're all working on it, then the question will be, where will we end up? Will we end up in a situation where the only type of money you're allowed to spend is the CBDC or the digital dollar or the digital euro or the digital pound, because they'll say you have to use the central bank digital currency because that's easy for us to monitor for tax evasion reasons, for anti-terrorist reasons, for anti-money laundering reasons. So as the money goes into your central bank digital wallet, you can't have more than 10,000 or 20,000 there. So anything excess will be automatically swept into your bank. And if you spend any money out of it, if you spend more than 10 or 20,000 out of your digital wallet, it'll be swept from your bank into your digital wallet, so that the transaction passes through something we can monitor. I can see that happening. And of course, what's in your bank and what's in your wallet is one-to-one. And that's all well and good until they say, uh-oh, we see that you're speculating against the euro or the yen or the pound or whatever it happens to be. That's not good because we're trying to run an economy. We don't want speculators. So we're going to limit what you can do. We'll limit how much you can move from left to right. So you can't actually, you can't use your money in the bank anyway. You've got to go through the digital wallet, but you can't put it in the digital wallet beyond a certain point, or without permission, or under certain circumstances. So suddenly you find there's all this money left behind in the system, which is effectively undeployable without permission or beyond a certain limit. So we then would have the Russian coupon system, where it doesn't matter how much money you've got, if you haven't got it in your digital wallet, tough, you can't spend it.
And do you think that is the end game of this play, the game that we're currently playing, this fiat currency play? You don't think we'll see a collapse of the system, return to gold, for example, like some analysts are outlining? You think the digital-backed CBDCs are the future?
Well, none of those are the plan. But of course, for each of these scenarios, all governments have got scenarios where if this happens, this will be our option. And of course, so gold standard is an option, central bank digital currency restrictions an option, exchange controls are option, capital controls, bail-ins. There's a lot of options on the table which they can look at. None of them are going to be very good if you happen to have a lot of cash or bonds. They're going to be very good for the government because it's going to basically mean that the old currency, to all intents and purposes, is no longer a problem, and they'll be able to start borrowing in whatever the new system will be. Because the old. So if you happen to be a bond holder or a holder of cash, large amounts, like money market funds or large deposits, you're most likely to be at the losing end of whatever happens. So that's why you've got to have something. We don't know what's going to happen. You've got to have something outside the financial system which can get you to the other side, so that when we get to the other side of whatever's coming, and something's coming because the debt is unsustainable, and almost everybody who's in the know agrees with that. It's not just me, Clive Thompson, saying it. Everybody knows that the debt is unsustainable. So at some point, something will go wrong. There'll be a panic, or there'll be a crisis, or there'll be a situation, or there'll be an event, and that debt will, to all intents and purposes, be cancelled. And I don't mean a default here. I mean a debt jubilee. It'll be paid off by a bail-in. Something has to happen. It can't continue. It's not sustainable, because we're reaching a point where the interest cost on debt will become higher and higher until it exceeds the total tax take and spirals out of control. This might happen in Japan. Japan's got a massive debt to GDP ratio. It's I don't know. It's getting on for 300%. It's well over 200% when I last looked, and the interest rates in Japan are rising very, very sharply now at the short end. It was only a few weeks ago we were panicking because they were panicking because it was going to go above 2 at the short end. Now it's 2.3. So every fractional increase in interest rates is starting to cost the government more and more. And the same situation is applying now. We're seeing, if we look at the US 10-year bond, we've been through a period of falling short-term interest rates, but the yield on these longer-term bonds is not falling, and now it looks like it's starting to creep upwards again. And what does that mean? It means it becomes more expensive for governments to finance the maturing debt, because the maturing debt was taken on a decade ago when interest rates were 0% or 0.25%, and now as it matures, they have to roll over that debt at today's interest rate, which is several percent higher.
Yeah, definitely seems like something has to happen, like you outlined earlier. This idea of a BRICS settlement currency is oftentimes floated around that could potentially be backed partially by gold, for example, 40%, the rest by the currencies within the basket of the BRICS countries participating. Do you think a partial remonetization of gold like that could potentially force the West, countries in Europe like the UK, the Netherlands, where I'm from, or the US or Canada, to also have to look at remonetization and take it seriously?
I've got no inclination that there's any move in Europe to do that. The BRICS nations and other nations, yes, I think it's likely that they'll go down the route of a central bank which will hold some gold and allow paper currencies or digital currencies to change hands between, say, Brazil and China and South Africa and other countries. And if there's a large imbalance, because each country will have deposited a certain amount of gold in the central bank, when the imbalance becomes too large, those surpluses will be changed for gold, so the ownership of the gold will change hands to the country which is in surplus, and the country which is in deficit will have less gold.
Clive, how do you look at platinum group elements, platinum, palladium, those type of metals within a precious metals portfolio?
I don't think it's very followed, but because the platinum group is so tiny, even compared with this silver group, I think it's 1/10 of the size, something like that, is absolutely minuscule. You don't need more than, let's say, for every 500 people who buy gold, you only need one of them to buy platinum, and it's moving the price.
So it could be a more speculative part of the portfolio, but not necessarily for fundamental reasons. Is that a fair way to summarize it?
Yes, it could be. I mean, I do have some exposure to platinum and palladium, actually, but more platinum. It's paper, by the way. I haven't seen fit to take physical delivery of platinum. I haven't sold any, despite the fact it's doubled in price. Do I think it's going to go higher? I think probably. I think it gets carried along with the whole of the precious metals sector.
All right, well understood. And how do you view the miners of precious metals, gold miners, silver miners? Of course, they can provide incredible leverage to a further move in precious metals, but they can also provide value at current prices based on their cash flows, the NAV, however one might look at it. Do you think it's an interesting place to be currently?
Well, up until about 6 months ago, the mining sector, the precious metals mining sector, had been left behind with the gold price rising. And I said, and a lot of people were saying, there's a huge amount of catch up to be done just to play even Stevens with the gold price. Now, I think we've done that, but I think there's probably a lot more to go. And the reason I say that is when the gold price rises, there's a leveraged effect on the profits of a gold miner. And I'll just explain that. I know many of your viewers will understand this, so bear with me for a second. This is for the benefit of those who don't. If you have a gold mining company who've been digging the gold out of the ground at a price of 2,000, and they were selling it, let's say, in the old days at 3,000, and that's not so long ago, they were making $1,000 profit. Now, let's say the gold price rises by another 33% to 4,000, which is what's happened. The gold miner, which was digging it out of the ground at 2,000 and selling at 3,000, now selling at 4,000. So their profit has gone from 1,000 an ounce to $2,000 an ounce. So a 33% rise in the gold price resulted for that miner in a 100% rise in the profits that they're making. Now, there's always going to be a lag because often it takes time to dig the stuff out of the ground, but they also sell some of that expected production forward anyway. But there's always going to be a catch-up. Now, what that means is almost every gold and silver miner we've seen reporting over the last year and a half or so has been reporting higher profits than they did in the same period a year before. and most often a higher profit in the quarter than the quarter before as well. And what I have noticed, and I think this is something that people should be aware of, more often than not, almost every occasion, when those profits are reported, the share price takes a leap upwards. So the day to, if you're in the mood for choosing your day to sell one, and I don't recommend this, by the way, you maybe want to look for when the next results are and sell just after the results, because what happens when a company, the analysts, they do the review of a company when they report the results, then they forget about it and do all the others until the same company reports its results again. Then they sit down, crunch the numbers and say, oh yes, as expected, it's made a much higher profit. Oh, and they're going to make a higher profit next quarter. We'll raise our target price. So what happens when you raise the target price? Well, there's armies of individuals and bots who try to buy the stocks which have got highest target prices relative to the current price. So the minute you raise a target price, you bring in an army of potential buyers who, even robots who are doing it are just saying, I buy everything where the target goes up. So inevitably, the time when that's going to happen is the day of the results, when they're announced to the public. So that would be my first thing. But the second thing to say is this. Given where we are with the prices of gold, if these prices, even if they come back $1,000, the profits are going to continue to rise. Maybe the share price won't, because the share price will react to the negative gold price, but the profits are going to continue to rise, and rising profits in the long run are a support to the underlying share price. Now, I think that if we get to a situation like that, we'll have a situation where we have all these gold mining companies at today's prices. They will be on low price earnings ratios, typically below 10, based on the future profits if the price stays where they are. But we'll have companies with rapidly rising profits on low price earnings ratios. That's not the way the market works. The market usually pays a high multiple, for companies with high growth in earnings per share. So I think that the share prices are not going to be on, right now the average P/E ratio of a gold mining company is something like 22. But if the gold price holds, even at $500 below where we are, those multiples are going to come down to below 10 for the most part. That wouldn't make sense. But when you've just, let's say over the last 12 months, got 50, 60, 70, 100% more profits, to have a price earnings ratio which is half what it was when your profits weren't rising.
No, that's a masterclass in thinking about these miners right there. And like you outlined, even if the price were to drop a little bit, the profits would be stellar, and these companies can redeploy that in form of dividends, share buybacks, or even growth in their assets, exploration, development. So there's a whole suite of companies with incredibly interesting pipelines.
Yeah, and I think the other thing to be aware of is some of the larger gold mining companies want to continue to maintain their reserves, so they have growing reserves over time rather than shrinking reserves, because we mustn't forget a gold mine is a hole in the ground where what's left in the ground gets smaller and smaller. And the way many of these very large companies have continued to survive over centuries sometimes is to continually refresh their reserves by buying new reserves. So I think that in this environment where there's plenty of companies which have got gold in the ground but no money to dig it up, some of them will be the targets of the biggest companies. And it's not a game I'm particularly keen on playing myself, but those who would like to play the game, the way I would do it is look for companies with gold reserves but no cash, and which are physically located close to a large company which does have the cash. Why? Why physically close? Because it's quick, it's easier to move the machines and the people and the resources around. It's no good a company which is mining in Canada buying a silver mine in Mexico, because it's too far to move the stuff. But moving the stuff between two parts of Nevada, for example, or two parts of Mexico from one town of Mexico to another one is a lot easier. So the way I would start is look at who the biggest gold mining or silver mining companies are. look what they are, where they're mining, and look which other companies are near to them geographically, and ask yourself, do these other companies have the wherewithal to dig it out of the ground? Because if they don't, now will be a great time for the big companies to make a move.
No, that's a great point. Neurology, there's plenty of explorers and even developers right next to big gold mines that, are prime acquisition targets in this market. How do you think about companies like, for example, a B2 Gold, to use it as an example for just a second? A company is trading at an incredibly attractive forward multiple because of a bit of geopolitical risk attached to it. Is that something that you're willing to look?
All gold and silver mining companies have a lot more risk than many other companies which do more mundane things. A geopolitical risk is one of those, because a lot of these gold mines, probably more than half of them, are in countries which are a lot less stable than Canada, Australia, and the United States. You've got this geopolitical risk, and the way you can mitigate that is by diversifying your holdings. So if you have, a lot of these companies are quoted, by the way, in countries like Canada, even though they're mining in Guatemala or wherever it happens to be. So the way you can mitigate it is, as you buy these companies, look to see where their primary mining activities are, and don't buy too many companies which are mining in the same country. So obviously Mexico, it's very easy to fall into the trap of buying lots of companies in Canada which mine in Mexico. But you probably want to limit that to one or two, and then have some companies mining in Sierra Leone and African countries, wherever they are doing. It doesn't really matter, but diversify it around, so that if one country goes to the wall or confiscates the mine or imposes heavy taxes, you're not excessively exposed to that one investment. In other words, it's the old story, don't have all the eggs in one basket.
Don't have all the eggs in one basket, definitely. Hey, Clive, earlier on the interview, you mentioned that you also talk to clients one-on-one. Perhaps you can shortly outline what your services are and how people can find out more.
First of all, I don't charge anybody any money for anything. So I've got I have nothing to sell. I don't require an email address. I don't I don't take credit cards. I don't take cash or any other form of payment. So I'm retired, and I'm giving, like a retired doctor, I get consulted about all the time about what people should do with their wealth. Having said that, I've got a long backlog running right through to February of appointments with people who would like some free advice. And I'm not giving advice, by the way. I want to stress I'm not an investment advisor, and nothing I've said is investment advice. What I am is a private individual who has a great interest in this, and it's a lot of fun. I've been doing it for 50 odd years, by the way. This is not new. I got 47 years being paid for it as working for banks, and now I'm doing it for free. But basically you could call it consultation in terms of helping people see their way forward, and I'm trying to help people see if their direction of travel is the right one. Just a small example that I said I was talking with someone just before you. The lady has got 55% exposure to the precious metal sector, and was wondering if she should increase that with some money. And my answer was, well, even if I'm bullish on it, it's not a great idea to be putting too many eggs in one basket, because we do not know what tomorrow holds. Something which none of us have foreseen happening could happen. What if a meteorite hits the world and it's made of solid gold? Well, the price of gold's going to go down. So you need to be moving into some different types of things. But that's not advice. It's helping us see the risks that she's taking if she continues to push our holdings of precious metals towards 100%.
Well understood. And what about the YouTube channel, Clive?
I started a YouTube channel in May, I think the first video probably had about 500 views. I had a couple which just passed 250,000 views, and I've got 100,000 viewers, 100,000 subscribers. I'm really pleased about that. Of course, that in itself is one of the things which generated all these interview requests from private individuals. wanting to see the way. Of course, I get a lot of very nice messages from people inviting me to lunch and offering to buy me beers and things. I would love to take everybody up on it. I simply can't. And I'd also like to apologize to the many, many people who write to me, and I try to write back to everybody. They contact me via LinkedIn. I also have a web page which is now being used. It's called clivethompson.com. So there's nothing to sell on there. It's just got some links to some of the more interesting stuff. I've got one of the things I put on there is what I call the 2026 Beat the Benchmark portfolio. Every year since 2023, I've been publishing a portfolio for the year called Beat the Benchmark. So you can get all the old portfolios as well as the new one. And I've beaten every benchmark every year with that portfolio. This is the very, very first year I put any gold miners in it. I think there's two gold miners in the portfolio of 40 stocks. But every other year, it's been only industrial companies, no Mag 7, no Bitcoin, no gold, no silver. And yeah, it's done very well every year. I think last year was 45%, something like that, in dollars for a 40 stock portfolio. This year we're well ahead already. We're only 15 days into the year, 16 days, 20 days into the year. We're about 6-7%, 8%, something like that, ahead of zero. The S&P is up about 1.6% in the same period. So, by the way, this is not a portfolio of best stocks or top picks or hot stocks. This is a portfolio which has been scientifically put together to work together. In other words, I'm not saying what's my best stock in America, what's my best stock in Germany, and buy those. That's not at all the way. I construct the methodology is quite complicated, but short answer is I build lists of stocks based on various criteria, various investment styles, and then I will pick one stock in Germany, one stock in France, one stock in Italy, making sure they're all different industries. Once I've got, let's say, 10 stocks, I start again, but trying not to ever get more than 2 or 3 stocks in the same industry, trying not to get more than 2 or 3 stocks in the same country, so it's as diversified as possible, and also trying not to get too many stocks with the same size. So I've got everything from mega caps through to not micro caps, but small caps, and I've got every investment style from growth companies to GARP, growth at a reasonable price, to income companies, to value companies, to dividend companies, to quality companies. So I try and mix up the styles of investment which are in there. So it's really a scientifically constructed portfolio. And I get people who write to me and say, Clive, you mentioned da-da-da company in one of your YouTube channels. Why isn't it in your portfolio? Well, that's not because it's not because the company I might have mentioned wasn't, in my opinion, a good company, but isn't good enough to go in the portfolio. It's because it doesn't fit. I might have already got, if I've got 2 gold miners, I can't put a third one in, even if it's better than the 2 I've got, because the 2 I've got, one happens to be maybe in Australia, the other one happens to be in Canada, and I can't remove the, let's say, I can't now insert an American company, which is a gold miner, because I've already got, even though it's better than the other 2, because I've already got too many American companies, if you see what I mean.
No, definitely. And we'll put a link to your YouTube channel as well as your website down below in the description. Clive, thank you so much for your time and insights today. It was incredibly interesting.
Well, thank you very much indeed, Stijn, for inviting me. It's been a real pleasure coming on your channel. Thumbs up to all your viewers. I'm very sorry if anyone's writing to me to say, can I do an interview? I'm having to stop taking appointments until mid-February now, I'm afraid, for the one-on-one interviews, but I will be doing it in due course, so feel free to write if you can give me a couple of weeks to clear the backlog.
Excellent. All right. Thank you so much, Clive. This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors under CEDAR Plus at www.cedarplus.ca.